Hello and welcome. Fincare Small Finance Bank revived its IPO plans and has now refiled the DRHP with the market regulator. Rajeev Yadav, MD and CEO of Fincare Small Finance Bank, is here with us today to discuss the bank's plans and strategies. Mr. Yadav, welcome to the show.
Thank you, Manojit. Thank you for inviting me.
Sir, in August, Fincare has refiled the IPO papers with SEBI. When are you planning to come up with the IPO?
So, Manojit, we will get we'll try and work within the validity of our approval and try and launch it within the validity period, which is typically 1 year.
So the validity period is next year, March, is it?
No. So depending on the formal approval date, it will be a 1 year from the formal approval date. So it should be typically 12 months forward from now.
But this IPO is to meet the regulatory requirements on listing. I mean, RBI regulation says you have to list the company in 3 years from time of reaching 500 crore of net worth, or it is because to fund the growth capital.
So it's a combination of both. We clearly have a regulatory deadline, and therefore the process is clearly designed for a regulatory compliance. But as would normally happen for a bank of our size, it is fair to make it public for larger shareholding, for diversified shareholding, and for raising incremental capital which is required for the growth capital of the bank. So it'll help us achieve both outcomes.
Because your capital adequacy ratio was pretty healthy as of March 31st.
Correct. Manojit, for a fast-growing institution like ourselves, and if you can see within COVID also, we have had a 25% growth rate last year. Prior to COVID, it was even higher. For a fast-growing institution, so all the 22% capital adequacy is sufficient. But the bank would always need more capital for keeping pace with its growth ambitions in the future.
AUM growth was 25% in FY22 to around 7,500 crore. Do you think the growth momentum is still continuing in the current financial year?
So obviously, I cannot talk specific numbers of our institution at this point of time, but there are various industry reports which are released by either Saha or MFIN on the microfinance side, and obviously by rating agencies which talk of secured portfolios and the credit growth. And I think the banking industry at this point of time is having one of the fastest growth overall as a banking industry, and clearly it is coming back from the post-COVID rebound where credit offtake was much lower, and therefore a bank like ourselves, which is targeted more to financial inclusion customers, basing the industry trend, be it both for microfinance, be it for other small SME loans, we do see growth rates coming back to normalcy, what they were pre-COVID, and which were clearly better than even last year.
Would you like to share some growth target for the current financial year?
Not really, given it's a cool-off period for us, because of the DRHP filing. So I wouldn't be specific about bank, but I think our past trend would be a good reference for some of the indicators of the future, and I think there is enough of untapped potential in some of the customer segments that we operate in. So generally, growth has not been that big a challenge, and it has been demonstrated even in COVID times.
But of course, there are certain challenges which you faced in the last financial year. For example, your profit fell to 5 crore from about 146 crore in the previous year. Your credit costs remained very high at around 4%. Gross NPAs were almost 8% as on March 22. Do you think those parameters, are there signs that there are visible changes in those parameters?
Absolutely. So again, I would encourage for you to reference some of the industry parameters, and the pro of the financial inclusion space that we have is that there's a huge untapped market. There is financial inclusion to be done. There are underbanked, they are unbanked. So there is a huge opportunity. But one of the cons is that the COVID has impacted that segment significantly. There is a significant nature of unsecured loans, and therefore one of the cons is that some of the delinquencies and NPAs got elevated in the COVID times. As you rightly pointed out, the bank had elevated NPAs, but they all peaked, a few quarters back. And again, the industry data is out there to give a reference to some of those numbers. The pre-COVID numbers, the bank's GNPA was under 1% with a net NPA of under 5 or 0.5%. So once the COVID impact on the portfolio eases up, and which largely the industry is seeing at this point of time, we should come back to more reasonable NPA and net NPA numbers. Although we should be broadly ready for a slightly different portfolio behavior given a difficult time. But as a CRISIL reports, as the ICRA reports are indicating, FY23 should be a much more profitable years for these industries, and clearly the NPA numbers will be much lower because in that phase.
One of the area of concern was collection efficiencies. Are you seeing those things going back to pre-COVID levels?
Clearly, the industry has started seeing the collection efficiencies in the early buckets going to nearly pre-COVID levels. And clearly the impact of a crisis in some of the portfolios that we have is about 3 to 6 months after the crisis. And on the extreme side, the portfolio shows its true impact in about 6 months time. And as you would realize that the last impact on the portfolio was in the wave 2, which was in April, May, June of 2021. And therefore, the worst of that impact would typically flow from the July to the December period of 2021. And then it is broadly, it normalizes to a reasonably pre-impact period. But in that phase of a crisis, obviously certain segment of customers would have become delinquent and they might become NPAs. But the people who are good in that, at that point, or what we incrementally build after that, tends to behave like a pre-crisis kind of collection efficiencies. And within the NPA pool or the delinquent pool, there has to be stabilization of the customers in terms of not is to encourage them to stabilize and start paying one EMI, and there's obviously recovery to try and roll them back. But fundamentally, the main pool, which is the non-delinquent pool, start behaving like pre-COVID roughly about 6 months after a major crisis. So 2022 has been largely in that direction across the industry of near normalization on the non-delinquent pool of customers.
So since we are talking about the micro loan customers, now small finance bank, which were earlier MFIs, they become small finance bank. I think 9 of them of the 10 who got the licenses. One of the challenges has been to diversify the portfolio. Their portfolio is very much tilted heavily towards the microfinance loans, even after 5 or 6 years of operation, and Fincare is no exception. I think 80% of your loans are towards the MFI customers. What is the plan to diversify the portfolio?
Right now, at least our data, what we have disclosed in the March 22 numbers, and if I can reference that, our diversification at that point was about 25%. In a larger context, the bank has a phase of what we call the build of the bank. And in the build of the bank, the most important build of the bank becomes the deposit franchise, because we did not have any deposit franchise earlier as a category. The second important category which gets built in is about the technology of the bank, because the technology is a hugely, different ball game. Just because it's a small finance bank, people do not have any different expectations from a mobile banking application, from our internet banking application, from our payment solutions. So you have to quickly catch up on all these technologies, besides all the infosec requirements and all the complicated compliances which come with the technology of the bank. So therefore, the second big build is out there. The third big build for a bank is on the compliances, the governances, all the nitty-gritties which make a bank run as a bank franchise. Now, loan assets is one part of it. And clearly there were loan assets. We had an expertise of doing one good product prior to the launch. And obviously we had another 1 or 2 products which were in the secured category at the time of launch, which were mortgage loans and gold loans. But, so in that phase, what you're trying to do is you're trying to build the remaining portion of the bank in the first 5 years. And also what you're trying to do is you're trying to diversify. But again, you have to be careful if we're in a world where these customers are untested customers typically that we lend to. And we are very, we have to be reasonably conscious of the credit risk that we take. They have to be calibrated. So diversification is necessary for an institution, for a bank over a point of time, but has to be done in a very calibrated manner. So I would say from virtually a 5% balance sheet, which was at the start of the bank, which was not microfinance, and these balance sheet sizes are growing. I also want to add the point. It's not a static balance sheet. So
Right.
when we look at the balance sheet that we started, I don't have the precise number, but they were under 2,000 crore, and today our gross loan advances are about 7,600 crores. So, on a static balance sheet or a slow growing balance sheet, diversification is easy, but on a fast paced balance sheet, diversification as a percentage is that more challenging. So in absolute terms, we would have added virtually as much as what we had of microfinance when we started the bank, but fundamentally, as a percentage, is reached about 25%. But this crisis, one, has given an opportunity for us to build a lot of secured capability in this phase, because as microfinance, sort of hit a hurdle, the effort of that side of the business went into focusing with the customers, getting normalcy in the processes, working through their in EMIs that they missed. So that business naturally went through a relatively slower phase. And from a bank's perspective, it opened up a window where the secured portfolio could be built at a faster pace, and therefore the mix is, in my view, across all the SFBs, and some of the numbers are in the public domain of the other SFBs. You would see the mix change. So I would think the need, firstly, the crisis did highlight the need for more diversification.
Right.
Two, the timing of the maturity of the bank was already there, and three, it just gave us the bandwidth to build a lot more secured, capability in this phase. So we are at about 25% right now, and I do see an accelerated pace. I'm trying to stay away from giving specific numbers.
I understand.
But other than that, I can say that I do see a reasonably faster pace of secured mix build-up in the portfolio.
Right. On that note, it was a pleasure talking to you, Mr. Yadav. Thank you so much for speaking to us, and wish you all the best for your IPO.
Thank you, Manojit. Really nice talking to you, and looking forward to more interactions in the future.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.